Hello everyone, welcome again. In this lecture we are going to continue with capital gains tax. I will quickly share the screen with you and now we will do the remaining parts of our capital gains tax. We will also do a question as well, which is a small question of capital gains tax in this lesson. So just bear with me. If you come to page number 30 of your lecture notes of ACCF 6, please. Capital gains tax, page number 30 of your lecture notes. Now, as you can see on your screen, it is a part disposal of an asset. Now, what happens is that sometimes if I hold a piece of land, say for example, the most common example in this case is a piece of land. Say for example, if I hold a piece of land and I sell part of the piece of land, say for example, if I had 4 acres of land and I sold 2 acres of land, and the only remaining 2 acres of land I did not sell it, so it is a part disposal of an asset. In that case, how to calculate the cost of the cost of the sold property, cost of the sold land, that is the way to calculate it. Now it says if an asset is a part disposed, then the allowable cost and enhancement expenditure for capital gains calculation will be calculated as follows. So it will be A over A plus B. Now the first A here is market value of the part disposed of. So whatever we have sold, which is obviously is going to be our sales value, and the part B is B in this case in the formula is remaining part of the asset. So if say for example, if we have sold 2 acres of land, so in this case value of the 2 acres of land is going to be A, and the remaining 2 acres of land, the value of that is going to be B, right? So it is A over A plus B is the way to calculate it, right? Sorry, page number 34 of your lecture notes. Sorry, not 30, page number 34. Sorry for that. So it's page number 34. Now as you can see on your screen, A over A plus B. Right, now A over A plus B, we will multiply it by the cost or enhancement expenditure if there are any, and that's the way to calculate the cost of a part disposal of an asset. Right, then we will do a question on this one in a minute. Just maybe 1 second. We have to cover a little, some more topics as well. Now that is a pro forma to calculate the capital gains tax. Now in this case, we will also include the assets qualifying for entrepreneurial relief as well. Now first off, we will list down the assets which are not qualifying for entrepreneurial relief. So take the sales, then we'll deduct the incidental cost of the sales. Cost and enhancement expenditure will also be deducted. Remaining amount is going to be gain. Then the second asset is the asset qualifying for entrepreneurial relief or investors relief. Excuse me. Plus investors relief. So we'll take the sales again and we'll take the incidental cost of sales out of that. We'll deduct the cost as well and enhancement expenditure. Right, and net amount is going to be again, and these are the assets not qualifying. So these are the assets qualifying for entrepreneurial relief or investors relief. Right. After that, we have to deduct the current year's capital loss if we have any. So we'll take the sales, incidental cost of sales and cost and an enhancement expenditure will be deducted out of that. That is our loss. Now while setting off the capital loss, our preference would be to set off against the assets not qualifying for entrepreneurial relief, as I said to you in one of the previous videos as well. Reason is because we will have to pay the capital gains tax at the rate of 10% anyway on the entrepreneurial relief. So if we set it off against the assets not qualifying for entrepreneurial relief, we will save more capital gains tax. If we set it off against the assets qualifying for entrepreneurial relief, then we will save less tax because we will lose 10% of that anyway, right? Assuming that the normal rate is 20%. So while setting off the capital loss, we will set off against assets not qualifying for entrepreneurial relief first, then against the assets qualifying for entrepreneurial relief. Right? So after that, we'll deduct the capital loss brought forward. Again, for that as well, preferences are mentioned to you. So first preference would be against the assets not qualifying for entrepreneurial relief. The second preference would be against assets qualifying for entrepreneurial relief. right? Now another thing is also, I might have told you in one of the previous videos as well, that in capital gains tax there is something called a residential property as well. Now tax rates on residential property is 18% in the basic rate band and 28% in the higher rate band. Now examiner won't examine in much detail, but you should know about it at F6 levels. There is something called a residential property. Now the question will tell you that it is a residential property, so then you know that the tax rates are different on the residential property, and the tax rates will be given to you in the exam anyway. So tax rates on residential property, capital gains tax on residential property, if it is within the basic rate band, it is 18%, and if it is in the higher rate band, it is 28%. Now while setting off the losses, first preference would be to set off against assets not qualifying for entrepreneur relief, as I said, and in that as well we will give preference to assets which are residential properties. Why would we do that? Because we know that assets which are residential property, we will be paying tax at the rate of 28%. So if we set off the loss against the residential property, then we will be saving tax at the rate of 28%, assuming it is within the high rate band, right? So first preference is to set off against assets not qualifying for entrepreneur relief, and in that section we will give the preference to the assets which are residential properties than the non-residential properties, because we will be paying tax at the higher rate of 28% in the higher rate band on residential properties, right? Capital losses brought forward, again our first preference is to assets not qualifying for entrepreneur relief, then to the assets qualifying for entrepreneur relief. And please remember, whenever we are setting up the capital losses brought forward excuse me, whenever we are setting off the capital losses brought forward, we will set off the most of the capital losses brought forward, but we will leave the current year's annual exempt amount, right? So we can set off the capital losses brought forward up to the annual exempt amount limit. So we will leave the capital gains tax annual exempt amount of 11,100. Now as it says in the notes, up to the amount that annual exemption remains, right? After that we'll deduct the annual exempt amount or annual exemption. Again the preference is to set it off, to deduct it out of the assets not qualifying for entrepreneur relief first, then against the assets qualifying for entrepreneur relief. After that it is going to be our taxable gains on which we have to pay tax. Entrepreneur relief tax rate is 10%, residential property rate is 18% and 28%, and normal rate of capital gains tax is 10% and 28%. 10% and 20%. Right? So normal rate of capital gains tax is 10% in the basic rate band and 20% in the higher rate band. Entrepreneur relief, even if it is higher rate or basic rate, you will still have to pay at the rate of 10% anyway. If it is a residential property, then if it is within the basic rate band, tax rate is 18%, and if it is in the higher rate band, tax rate is at the rate of 28%. Right? On the next page it says chattels. Now what is chattel? Chattel is basically a tangible movable property. Now you might have studied tangible and intangible things at F3 or F2, financial accounting or management accounting. Tangible thing is a thing which has the physical existence and it is movable as well. So tangible movable property is something called chattels, right? So if it is tangible, it has the physical existence and it can move as well, then it is a chattel for our F6 purposes. So chattel is a tangible movable property. Wasting chattel is a chattel whose useful life is less than 50 years. A wasting chattel like what? Like you can say this iPad is also wasting chattel. It is tangible, has got physical existence, and it is movable. I can move anywhere, right? So, and it has got life of less than 50 years, right? So it is a wasting chattel. So how to calculate the capital gains tax? Sale of wasting chattels. If it is a wasting chattel, it is going to be exempt from capital gains tax, right? So let's see about other non-wasting chattels. A sale of chattels for less than £6,000 and gain arises. Now if we have sold the chattel and the proceeds are less than £6,000 and we have made a gain, then it is going to be exempt. Right, so sale of chattels for less than £6,000 and gain arises, it is going to be exempt, which means that sales proceeds will be less than £6,000 and cost will be less than £6,000. Right, so if sales is less than £6,000 and cost is also less than £6,000 and we have made a gain, it is going to be exempt. Right, now after that it says a sale of chattel for less than £6,000 and a loss arises. Now say for example, if we have sold for less than £6,000, maybe 1 second, sale of chattels for less than £6,000 and the gain arises. Yeah, sale of chattels for less than £6,000 and the loss arises. Now say for example, if a loss arises, we have sold a chattel and we have sold it for less than £6,000. However, a loss arises. So in that case, loss is calculated assuming if the sales were £6,000. Now the loss cannot be changed to gain, but loss can maximum reduce to zero. So say for example, if we have sold for less than £6,000 and a loss has arisen, I have sold for £5,000. Say for example, if I have sold a chattel for £5,000, then I will make this sales. I will assume this sale as £6,000. So I will make up a figure. So I will say I have sold it for £6,000. Right? So if loss arises, only then we will do that. And please remember that loss can only be reduced to zero. It cannot go into negative as it says. So loss cannot change the gain. Loss cannot change to gain, but the loss can maximum reduce to zero. So if it is a loss, we can only maximum reduce it to zero. It cannot go into the gain. Right, after that it says a sale of chattels for more than £6,000 and a gain arises. So we have sold for more than £6,000 and a gain has arisen. Then we will limit the gain. So how will we do that? A gain is restricted to maximum of 5/3 of the excess of £6,000, excess of proceeds over £6,000. So we'll take the sales proceeds. We will deduct the £6,000 out of that, and then we will multiply it by 5/3 as it says in the notes. So that is the way to calculate in chattels. Right? And after that it says a sale of chattel for more than £6,000 and a loss arises. Normal CGT calculation will do that. And if we have claimed a capital allowance on a chattel, say for example, if it was a plant and machinery, we have already claimed capital allowance on plant and machinery anyway. So on that asset, we won't have to pay any capital gains tax. Right? So it says a sale of chattel on which a capital allowance has been claimed, capital gain is zero, so no gain, no loss. After that it says intangible assets. Now while we sell any intangible asset like goodwill or a copyright or a patent, then we will take the reduced value of that asset. So we will be amortizing that asset every year. So whatever its net book value is going to be, we will use that value while calculating the gain. Examples include copyright, registered designs and patents. When calculating capital gains tax of such asset, and its depreciated cost, which is net book value, should be used in CGT calculations instead of the cost. So what we do, we will use the reduced cost, depreciated value, net book value. Right? Our next topic is principal private residence. Right? Principal private residence. So what happens is that, say for example, if you have a property and you have been living in that property for some time, then you left that property for some period, so because you needed to go for a job overseas or you needed to go for a job to UK or something like that. But yeah, that property is the principal property, that is your main property. Say for example, if you have 2-3 properties, then you will have to elect one of that property, which is your principal private residence, in which you normally live. So that is a property in which you normally live. Right? Now it says, a gain arising on the sale of an individual's only or main private residence, which is called principal private residence, exemption can be claimed up to the period of occupation over total period of ownership. Say for example, if you have owned that property for 120 months, but you have owned it for only 20 months, then you can get according to that, right? So it is called principal private residence exemption. So you can get the exemption according to the period of ownership, according to the period of occupation over period of ownership. So the more time you lived in that house, the more exemption you're going to get. However, there is something called actual occupation, which means that you have actually been living in that house, and there is also something called deemed occupation, which means that you have not been living in that house, but HMRC says that if these things apply, if these conditions apply, we will assume that you were living in that house. That is called deemed occupation, or you can say assumed occupation. When calculating the period of occupation, the last 18 months are always treated as a period of occupation, which means that last 18 months will always be treated as deemed occupation. So one will be actual occupation, and last 18 months before selling will always be deemed occupation. Another thing it says, some period of absence may also be considered as occupied, which is a deemed occupation, provided the period of absence was at some time both preceded and followed by the period of actual occupation. So some of the deemed occupations are as follows, as you can see on your page 36. However, these will only apply if we have been actually occupied the house before that and after that. Before and after what? After these events. So what are these events? The period of deemed occupation, up to 3 years for absence for any reasons. So if you have been absent for 3 years, provided that you have occupied the house before that and provided you have occupied the house after that, then up to 3 years you can say that it is for any reason. You can say whatever reason you may choose, and that will be deemed occupation. After that, it says any period of spent abroad for employment purposes. So if you have a job here, if say for example I am working for Account Institute, my boss says to me you have to go to Dubai and for one of the lectures, then that is I'm going overseas. So for whatever period it is, it will be deemed occupation, provided again it is preceded and followed by actual occupation. Up to 4 years of absence to live elsewhere due to his work, that is within the UK, right? So the previous one was abroad, whereas this one is within the UK. So up to 4 years of absence to live elsewhere due to his work. Because of his work, he had to go to, say for example, from London to Birmingham. I was giving few lectures in London, then I was asked my boss to go to Birmingham to deliver further lectures. So up to 4 years is exemption. Right? Now, same thing, the PPR relief will be extended by something called letting relief. It is also part of the principal private residence relief. Now, if your principal private residence has been, if you have let it out to someone else, then you will get the letting relief as well. So principal private residence exemption is extended to gain accruing while the property is let. The letting exemption is lower of these three, so gain already exempt under PPR, which you have already calculated, and gain remaining after PPR. So letting part of the gain, so we'll see how many months have this property let to the tenants. So we'll take according to that. So the letting months over total months, so that we will calculate like that. And £40,000, so whichever is lower, that is our letting relief. And after that, it says part of the house used exclusively for business purposes. If part of the house is used for business purposes, then PPR will not be given to the part of the house used for business purposes. Because it is a principal private residence, it's only on the private residence part which is used for the business purposes, we won't give any relief at all. Right then, so let's do a couple of questions. First one of which is on the principal private residence. If you come to page number 120, sorry, not page number 120, 125 question of ACCA F6 taxation, question number 125. It was examined in December 2011, and it says, George disposed of the following assets during the tax year 16-17. On 30th of June 2016, George sold a house for £308,000. The house had been purchased on 1st of January 1999 for £93,000. So it was sold for £93,000 in 1999. Sorry, it was purchased for £93,000. It was sold for £308,000. On 10th of June 2006, George had incurred legal fee of £5,000 in relation to the boundary dispute with his neighbor. So it is basically enhancement expenditure, you can say. So it is basically enhancement expenditure, you can say. Right? After that, it says, throughout the 210 months of ownership, the house had been occupied by George as follows. Now this is the period of ownership and occupation. Excuse me, the period of ownership is 210 months and occupation is given just below that, just beneath that. Now let's read the requirement first. What does it say? It says calculate George's taxable gains for the tax year 16-17. So let's see. So we'll see how many months are in total. We know that total months are 210. Now we have to see that how many months he has occupied, including both of them, actual occupation and deemed occupation. So we'll have to see the period of occupation. So whatever the period of occupation is, we will get the PPR, principal private residence. And it says, first of all, it says 34 months are occupied, which means it is actual occupation. So first 34 months we'll get the relief on that. So we'll add 34 plus. After that, it says unoccupied, travel overseas. Now he's traveling overseas, and these are 18 months. So we know that up to 36 months we can say for any reason. So we will include this 18 months for any reason. So 24 plus 18. After that, it says 24 months unoccupied, required to work overseas by his employer. So if you are going to work overseas for your employer, you can do so for 3 years. So this will also go. This will also count towards the. Overseas is not 3 years. Overseas is any period for overseas purposes. So this will also go into the occupation period, right? Because he has been overseas for the employer purposes, for his job purposes. After that, it says 11 months occupied. Now, how many months are allowed for any reason? For any reason, 36 months are allowed. So we have already used 18. So we'll use these 11 as well for any reason. It is already occupied. I beg your pardon. This is already occupied, so we don't have to do anything with it. And after that, it says number 30. 30 months unoccupied, required to work elsewhere in the United Kingdom by his employer. So you are required to work, from London to Edinburgh or somewhere within the country. Then you are allowed for up to 4 years. So he has already been 30 months, for employer purposes within the country. So he is still allowed how many? 48 months. So total months are 48. So he's still allowed for 18 months. Right? So after that, it says 22 months unoccupied, traveling overseas. Now he's traveling overseas again. So we know that for any reason we can do for how many months? For 36 months. We've already used once 18 we've used 18 months. Yeah, we've already used 18 months for any reason. Now another 18 can also be used, right? So out of these, how many are they? Out of these 22 months, 18 months we can use for any reason, and the remaining 4 months will be chargeable months, right? So we have only seen 4 chargeable months so far. The rest of them were, either deemed occupation or actual occupation, right? So this one 22 was done as well. After they said 26 months unoccupied, required to work somewhere in the United Kingdom by his employer. So he's required to work elsewhere in the United Kingdom for how many months? 26 months. Previously, how many months? 30 months. So altogether, 30 plus 26, 56 months. We are only allowed 48 months. So we'll take 8 months out of that, and that will be chargeable as well. So 8 more months will be chargeable, right? So after that, it says occupied. So after that, 17 months for actual occupation. So you don't have to worry about that anyway. And after that, it says unoccupied, required to work overseas by his employer. Now we know that when he's overseas, up to whatever months are, all months are allowed. So all months are considered as deemed occupation. However, only if it is both preceded and followed by actual occupation. Now let's see if it is preceded and followed by. Although it is preceded by actual occupation, but after that there is no occupation after that. Is there? It is unoccupied, traveling overseas, and unoccupied, living with sister, which means it is preceded by actual occupation, but is not followed by actual occupation, which means that these months will be chargeable. These months won't be allowed for normal purposes, right? And after that, if we see 13 months and 3 months, we include 13 and 3, 16 months, and we know that last 18 months are always considered as occupied. So these 13 months plus 3 months, 16 months, we can do 2 more as well. So out of 12 months, which are for required to live overseas, we can take 2 months more out of that. So because last 18 months are allowed anyway, right? So I will show you the answer as well. Maybe 1 second. Let's see if there is anything else. And after that, it says George left the house during all of the period when he did not occupy personally. Throughout the period from 1st of January 1999 to 30th of June 2016, George did not have any other main residence. So we know that he can claim the letting relief as well. He said for the period for which he was absent, he has let the property to his tenants, right? So we can calculate the letting relief as well. After that, it says on 30th of September 2016, George sold a copyright for £83,000, 80,300, right, pounds. So he sold for 80,300. He had purchased for 70,000 pounds 10 years ago, right? And he said unexpired life was, no, sorry, not 10 years ago. The copyright had been purchased on 1st of October 2014 for 70,000 pounds when it had an unexpired life of 10 years, which means we'll have to take 2 years of depreciation out of that. So 14,000 pounds because it is 10 years, so we'll take straight line. So 70,000 pounds divided by 10, 7,000 pounds is depreciation for 1 year. We have to take 2 years depreciation, so we'll deduct 14,000 pounds out of this cost of 70,000 pounds. So his cost will be reduced by 14,000 pounds, which means it is going to be 56,000 pounds. Right? After that, if you look at note number 3, on 6th of October 2016, George sold a painting for 5,400. So he has sold for less than 6,000 pounds. The painting had been purchased on 18th of May 2012 for 2,200, which means that the sales is less than 6,000 pounds and cost is also less than 6,000 pounds, which means that there won't be any capital gains tax on it. After that, number 4, it says on 29th of October 2016, George sold a motor car for 10,600. We know that motor cars are exempt from capital gains tax anyway. We have seen few assets which are exempt from capital gains tax, one of which was motor car, so there is no capital gains tax on motor car anyway. Right? So let's I will just show you the answer as well. 125. Bear me 1 second so that you know about it. 125. This is our question. So it says principal private residence exemption. So it has divided the 3 months. One is total months, then chargeable months and exempt months. So first of all, it says actual occupation. So these are exempt months, we know that. Then it says deemed occupation up to 3 years for any reason. So we have already used 18 months this time, right? After that, it says 24 months deemed occupation for any time employed overseas. And likewise, you can read all of the answer yourself, right? So principal private residence, exempt months are 188 months, total months are 210 months. So we'll take 210,000 pounds multiplied by 188 over 200. So that is our principal private residence, right? Now what we have to do is we'll have to do the letting exemption as well. So whatever the letting months are, so we'll have to multiply it by 210,000 pounds multiplied by letting months over 210, right? So let's see here. Again in letting period, so 210,000 pounds multiplied by 22 over 210. Why 22? Because these are the 22 months for which he was not occupied, and these are the months which he let the property to the tenants. So 210,000 pounds multiplied by 22 over 210, that is letting part of the gain. Now it will be lower of 3 things: 40,000 pounds letting part of the gain, and the gain already calculated under the PPR as we have seen in our notes. So lower of these is 22,000 pounds, right? So therefore letting exemption is 22,000 pounds. For copyright, we took the sales proceeds and we have taken the depreciated cost as we have seen in our notes, and the gain is going to be 24,300. And after that it says it doesn't say anything about the car and the wasting and non-wasting chattel. So he hasn't mentioned it. I think they forgot to put it in the answers. So don't worry. About the non-wasting chattel, which was sold for less than 6,000 pounds, and the cost was less than 6,000 pounds as well. So we know that there is no capital gains tax on that, and cars are exempt from capital gains tax anyway, right?